Hello and welcome. Thank you so much for taking the time out to watch this recording. I really do hope it's helpful to you. The downside of a recording, of course, is that you can't interject with questions, but please be reassured that my contact details will be displayed throughout, so you can contact any of the team subsequently with any specific questions that don't get answered today. I'm also going to give you some really useful links to other people that may be able to assist. The positive of a recording, however, is that you will be able to press pause to go and restock your caffeine supplies, and also to press pause if I talk too quickly. This is obviously a really, really big topic that I am going to try and keep condensed to about no longer than 40 minutes or so. So with that in mind, let me just sort of outline the planned agenda really. Now, I do appreciate that everybody watching is going to be at a completely different stage, dealing with a completely different set of circumstances. And also the organisation that I represent, and I'll give you a bit of a more formal introduction in a second. We very much work in the care home immediate need market, so people that are actually looking for, choosing, moving into a residential or nursing home setting. So a lot of what I talk about is sort of geared to that area because that's my specialism. But of course, I will try and expand that out to the earlier stages, accepting that some people may be wondering how it works for care at home or simply planning ahead and awareness. What we do know for everybody, though, is that the care system is very confusing, and if you're approaching it for the first time, it can be all of the things on that road sign there. So the three sort of core areas that I wanted to cover in this recording is who actually pays for a stay in a care home. If it's something you've never dealt with before, then the chances are it will be very, very confusing right now as to how it all works. We also hear quite often language around the family home about, mum and dad worked all their life and, the government's going to take it, or the local authority will take it. I just want to dispel a couple of myths and hopefully provide some reassurance really around how it does work with the property. And also to look at, in the absence of any sort of government fix to social care, we've had many governments talk about it, we've had proposals, we've even had legislation, but that's unfortunately been U-turned, and we do await announcements. So at the time of recording this in the kind of spring of 2021, this is we are still waiting. Let's look at whether a family or an individual can cap their own care costs. Okay, so that's the sort of plan. I've got a few extra little bits towards the end with some useful links for you and some planning ahead tips, but that's what we're going to try and cover in this webinar. Throughout the slides, you've got our website address at the bottom, and it is really important that you put group, not Eldercare, on its own. If you put Eldercare on its own, actually might be quite useful. It's an alarm company, a pendant alarm company, but for financial questions, you need to have the group in there. So just to give you a bit more of I said I'd introduce myself more formally. So Eldercare Group comprises Eldercare Solutions, that's the financial side of things, and Eldercare Property Partners, which can help if there is a property that does need to be sold when someone moves into care. You can read a bit more about the services on the website. But we are a firm of IFAs. You'll be perhaps familiar with the term independent financial advisors, and we have been accredited by the Society of Later Life Advisors. That's really just the sort of gold standard for advice if you're looking beyond general financial advice. All my team are SOLLA accredited, but within that, where some SOLLA colleagues will have quite a broad remit and might be talking about retirement and those sorts of things, later life matters, we do tend to just give our core advice is around, as I said earlier, somebody actually going into a residential care setting or needing care in their own home, but the need being now. So we're at Need Care Fees Funding Solutions. The business was actually set up, it's my company. It was set up 2007 in its current format, and that was really just because my family went through this journey unassisted. My grandparents both needed to go into residential care. and we got no advice whatsoever beforehand or at the time. I'm not blaming anybody for that. We didn't realise that there was any advice to seek that could help us. So we fumbled around the system ourselves. The property was sold, the money ran out. We didn't really think there was any alternative. So it was only when I found out later on in my professional career that that didn't have to be the case, that I set the business up to try and make sure other families didn't bumble their way through as we did. Obviously, as IFAs, you'd expect us to have all the appropriate regulations, and we are indeed directly regulated by the Financial Conduct Authority, the FCA. Now, I'm talking to you in various parts of the country, probably nowhere near where I am in Hertfordshire, but actually we've always given our advice remotely, even pre these strange lockdown times, phone, email, sometimes post, certainly more latterly FaceTime and Zoom. And the reason we've done that is mainly for efficiency, simply to take travel time out of the equation, but also because often there's family decisions at play here, and it's much easier to make sure that nothing is lost in translation if we are copying all family members in on an email, or we're having a conference call with all relevant parties involved. So it's really just to have that very, very clear audit trail. These are important matters, and we want to make sure, as I say, nothing gets lost along the way. We are not a charity, we are a commercial entity, but we're quite an unusual commercial entity in that about 90% of our work is done on a charitable basis. Now, that is by choice. We could, of course, set a charging structure for conversations with people, for report writing, etc. But in this area where people don't know what they don't know, and it's really difficult to get all the advice in one place, we don't want to put up extra barriers. So we are happy, it's my business decision, we're happy to share our experience and our knowledge with people and put them on the right track. There'll perhaps be a limit to how many hours we might spend doing that, of course, but usually in a relatively short space of time we can get people in possession of what they need to know or who they need to talk to next. There is an area of our business model where we will be paid, and that's if we research a particular financial product for a family and they end up implementing it. We get paid for that product implementation, but it's not right for many, many people. So as I say, we are happy that those we do get paid for will cross-subsidise it and enable us to give the free service to everybody else. Personal choice, it seems to work in the main. So that's us. As I say, you can have a look on the website and find out a little bit more. But back to that agenda, which was to look at, in the first instance, who actually pays for care. So as I say, I'm talking predominantly about somebody moving into a care home setting, but a lot of this is applicable for care in one's own home as well. And I don't really discriminate. It's up to a family that knows the individual what solution is going to work best, whether care at home will work best or whether a move to care is the better option. But if we are looking at that care home scenario, I've kept this really simple. We are in a strange time where there is some emergency COVID funding still around. There are things happening, discharge to assess, that wouldn't normally happen. And we do have potential government changes afoot, allegedly. So I'm just and can only talk about the system as it was pre-lockdown and as it still stands when the emergency funding washes through. And that is that there are three funding streams. You're either funded by the local authority, social services, the council, it's fundamentally the same place. You could be funded by our much loved NHS, or you are a self-funder, private fee payer. Okay, there is some overlap, but as I say, I have to, for time reasons, keep this really simple. So if we take them one by one and we look at that local authority funding first, if somebody is needing potentially to move into care, or is needing to up the amount of care that they're having at home, perhaps it's informal care being delivered at home at present, and we now feel that more external support is needed. The first thing that should happen is a care needs assessment being requested from the individual's local authority. And that phone call ought to be about booking a time to assess needs, it shouldn't be asking questions about money, because regardless of who's going to pay for this, everyone's entitled to a care needs assessment, including carers themselves. That's really important. So care needs assessment first, and this is done to see whether the individual meets that particular council's eligibility criteria. If they don't, and the local authority disagree that a move into care is necessary or that extra care at home is necessary, then it's academic really about the finances, because the local authority aren't looking to support. They'll only support if you meet the eligibility criteria. I can't state what that is. It does vary, but it's about meeting that person's needs and looking at their best interests. Only when that care needs assessment has been done should there be a conversation about who's going to pay for the needs to be met. And that's the financial assessment, or the means test. That's the term that you perhaps would be more familiar with. So care needs assessed first, then a conversation about the money. Okay. And in really, really crude terms, this means test is looking to see whether somebody has above or below 23,250 of capital. That's in England and Northern Ireland. It's about 3,000 or 4,000 more in Scotland. And in Wales, it's a more generous £50,000 capital limit. Now, whenever you look at this subject online, you'll see the upper limit, a lower limit, and that you get partial this. Honestly, it's so much easier for you just to think about whether you have above or below the 23,250. Somebody that's between 23,250 and the lower limit, semantics. It's just they have to pay a little bit from capital, which somebody with less than 14,250 doesn't. That's the only difference. So don't get too bogged down with that. I always see that online, and it's a bit of a distraction. So above or below the 23,250, that's the key to whether you get the funding or not. And what are they looking at when they say capital? What actually counts? Well, it would probably be easier for me to just say everything counts, but there are a couple of notable exceptions, and it's really important that I draw your attention to these. Now, if we're talking about a couple, if we're talking about mum and dad or aunt and uncle, it's only the individual that is needing care that can be assessed. So questions about the partner who doesn't need care don't have to declare anything about your income or your capital. Anything that's jointly owned, that of course does have to be disclosed, and 50% of that will be included in the means test for the person needing care, and of course 100% of their own capital. So there's a really useful, Age UK have the best fact sheets ever on most topics. I would strongly direct you to their website for their fact sheets, but there's a particularly good one on paying for care if one of you in a partner situation, one of you needs care, one doesn't. And it talks in there, and I'll mention it again later, about potentially equalising savings. If you can do that ahead of time, all well and good. No one knows which of you might need care first, if at all. But certainly at the point of one of you needing care, if the joint capital is significant, then it would make sense for the person not needing care to take their half out. Can't mess with the percentages, but they can move their own half out. And as I say, the fact sheet will sort of show you a calculation as to why. So that's a really important exception. Sometimes everybody disclose, we're used to living as couples, so we sort of declare everything as couples, but we don't have to do that when it comes to care. It's just the person needing the care that's assessed. Now, the property, this is a big one. It didn't used to be a big one. I'm advised by somebody in the know that lots of social services departments are using agency workers at the moment, and perhaps they don't understand the rules clearly. And we are hearing of people being told that a property is included in the means test when the spouse lives there, that they can come back and get the money later, etc. Absolutely categorically not. If we are talking about a scenario, one leaving the home, one staying in the family home, the family home is disregarded as long as that individual stays living there. If a relative over 60 lives there, it is also disregarded as long as that is a genuine cohabiting situation and they haven't just moved in. And of course, if you're having care in your own home, then the home is a disregarded asset. So there can be no talk, if it is a disregarded asset, there can be no talk of sort of putting charges against it or coming back to claim it later. Disregard means disregard, it doesn't exist. So that's really, really important. Again, I appreciate there'll be odd situations for some of you where perhaps half of the property is owned by a parent and maybe the other parent has died but left their half down a generation. So half of the property perhaps is owned by children, half is owned by a parent. We can talk you through those individual scenarios. It will be all too complicated if I start to address those now. The only other real asset that is disregarded from the local authority means test is a particular type of investment bond if it includes life insurance. Again, a very bespoke type of product. You might not know if you're acting on behalf of somebody else whether what they have is or isn't one of these. We can tell quite quickly, so please do check with us. They can be cashed in to use to pay for care, but they don't have to be. That's the subtle difference. So that's sort of broadly what's included as far as the means test is concerned, but they will look at income as well. This is a bit of a complex slide. Again, trying to keep it simple for you, so I am only scratching the surface here. If the local authority are agreeing to pay for somebody, that's whether they're in a care home or for their care at home, which if it's at home, by the way, often comes in the form of a direct payment. You get a sort of budget cash to spend how you will, whereas in a care home, the money is usually paid directly to the care home. But income counts as well. So the local authority will have an amount that they might agree to pay to meet somebody's needs, but they will then expect you to contribute your income towards that. Okay, if you have a spouse and you have a private pension, they can retain up to 50% of that private pension, but you are expected pretty much to pay anything else you have towards what the council will pay. So it's not the council pay this and I can pay my pension on top. It's the council will pay this and I'm expected to contribute my pension, all bar £24.90 a week of it, towards what the council will pay. That's a real distinction there. So as I say, they'll have a limit on what they'll pay, but it shouldn't really just be a figure plucked out of the air. It is meant to be a figure that can legitimately meet that person's needs. So if we're talking about a care home placement, then there must always be a care home placement on offer if the local authority are funding that will meet that person's need, and that the local authority's contribution, including your pension, will cover in full. In other words, an option that does not require a top up from anybody else. There must always be a no top up option on the table. And it has to meet needs, it has to be reasonable. So if there's a couple, then you would argue that the one staying at home needs to be able to visit, so location is key, etc. What the local authority, how much the local authority agree to pay that home is kind of between them, and they will get a discounted rate. The local authorities pay less than private fee payers, often because they're buying in bulk. So they're paying for the beds whether there's somebody there or not. So they get a discount. But there always has to be that legitimate offer on the table. Now, there are two scenarios where a third party top up can be requested. One is if you or the individual rejects that local authority place that's on offer, say, well, thanks very much, it meets needs, but we don't like it. We prefer this one, and this one costs a bit more. Then that one that costs a bit more can ask for a third party top up. Okay. The other time a third party top up can be requested is if somebody has started off as a self-funder, gone into a care home of choice. They then run out of money, and depending how soon this happens or what the care home contract said or whether the local authority and the care home can come to some agreement, in that scenario it's possible that to stay at that particular home the care home may require a third party top up. Again, that's something you really should ask when choosing a care home, what would happen in the scenario of somebody running out and the local authority stepping in. It's not the local authority that just move people, it's down to the care home whether they will accept what the local authority offers financially. That's another bit of a myth that's out there. Okay, so just be aware of those two situations. Otherwise, in any other scenario, the individual can't top themselves up. It has got to be that third party. So that's our sort of whistle-stop tour of the local authority funding. That's social care. That's where needs are predominantly things like help with washing and dressing and so on. And that's our means tested system. Running completely parallel but separate is the NHS funding. I could, well, I couldn't, but I could ask somebody that knows more about it than me to do an entire session on this. I know people that are very passionate about their knowledge in this, their ability to be able to support you in a claim and so on and so forth. I only have the time to literally mention it. And this is where if somebody's needs are healthcare rather than social care, so we've moved from sort of help with our personal care needs to health needs, that's when the NHS might pay for somebody's care, even if they're in a care home or having care at home. We know that if we were in hospital being treated, when we leave, we don't get a bill. Just because somebody's having the care at home or in a care home setting, if it is the same sort of care, so complex, unpredictable, unstable, definitely needing a medical professional to be involved in the care, that's when, as I say, the NHS ought to step in. Now, we can give you a link to support agencies. We can give you a link to the actual assessment tool that the NHS use when working out if somebody qualifies for this or not. It's difficult to get. It shouldn't be as difficult to get as it is. It's totally unfair, as we all know, but it is there, and it's something that people might not qualify for initially in their care journey, but certainly might at some stage. There's a level just below this where the NHS will pay a contribution just under £190 a week. That goes normally directly to the care provider, so sort of take the edge off the increased cost when nursing care first starts to be needed. So again, as I say, we can do a whole different session on this, but just to flag it up for today. So in summary, if somebody is not eligible for state funding because they have too much money, they're not eligible for National Health Service funding because they're not poorly enough, then they are a private fee payer, a self-funder. And about the only positive news I have for the session today is that you can claim or retain attendance allowance if you are self-funding your own care. People think often that this stops when you move into a care home, and some people get it confused with carer's allowance. This goes to the individual, the person that needs the care themselves. So this is a tax-free, non-means tested state benefit. You see the two rates there, and one is just a sort of if you need daytime attendance only. The other one is if you need attending to at night as well. On our website, which again you've got the address there, at the very bottom of our homepage, there's 4 really useful links. One I'll just mention before I forget, which is actually for carers. It's to a charity that supports carers. One of them is to the government website where you can actually put a claim in for the attendance allowance. So if you're not aware of it, use that link. You'll be able to see what it is and get the number to claim. I would also say that we do have a link to a very helpful lady recorded the filling out of an attendance allowance form on YouTube. It's quite long because it's quite a long form, but she takes you page by page through it so that you kind of can see what sorts of things they're looking for to get a successful claim. So that's a positive, hopefully. The only other state support that is available for self-funders, and this next couple of slides I'm talking about, is only if you are moving out of the property into a care home, so not relevant for domiciliary care in your own home. But I do have to mention it because it often doesn't get mentioned, or it gets mentioned incorrectly, and it does seem to affect lots of people, certainly if they are moving into care. So this is where the property would be remaining empty, so not the scenario we talked about where a spouse is staying there. So it's only for a vacant property or initially vacant property, and it's where basically the value has to be ignored by the local authority for the first 12 weeks of a permanent move into a care home. It's again only relevant if the other assets, if the cash at bank is under the capital limits that we talked about earlier. But the idea of this, the idea of ignoring the value for 12 weeks, getting state funding for those 12 weeks, and it's getting state funding in the way I've described it earlier, with the exception that it can be paid to the home of your choice. It doesn't have to be restricted to one on the local authority list, for example, and the care home can charge a top up during this time, which can be the individual themselves can top up. It's the one exception. But the idea of this, to get that state support for 12 weeks, was to give the family breathing space and decide what they want to do. I mentioned at the beginning on the agenda, point 2, the house, do we have to sell it? The answer genuinely is no. It's not for everybody, what I'm about to suggest, but if you're acting as power of attorney for mum or dad or auntie or uncle, it's worth just mulling this over and thinking it through. Could the property be rented out? Is it in a condition that means it could be rented out? Is it in an area that would attract decent rent? If the answer is yes, then why not rent it out? Now, there'll be things to think about there, of course: income tax, capital gains tax after a period of time, void periods, bad tenants, cost of maintenance of the house, etc. But for some people it works, and it's just going to make the money last a little bit longer, go a bit further. You know, selling a property and investing the proceeds, well, you know, stock markets and anywhere that is going to give you more than the guarantee of 0.5 to 1% that you'll get in a deposit account, it won't be guaranteed. It can fluctuate. Not many attorneys want to take that sort of risk. So rent actually is quite low risk. However, if you're a few steps ahead of me, you'll be thinking, well, even if we rent it, once we've accounted for tax, add it to the pensions, add it to the attendance allowance, it's still not going to meet this care home fee. Well, why not ask the local authority to lend you whatever you're missing, whatever you're short by? Now, equity release, again, I'm not going to give you the pros and cons of. What I'm going to tell you is that in this scenario, someone moving into a care home, leaving the property vacant, equity release isn't available. They won't lend on properties that aren't owner occupied. So totally worth considering, with some caveats for care at home. If you need to raise extra funds, not appropriate in this scenario. The only real way to get funds to top up any shortfall would be to borrow it from the local authority under a deferred payment agreement. It is the equivalent of equity release. It's mandatory for all local authorities to offer it. There is interest payable, but less than 2% and a setting up fee, so cheaper than a high street mortgage lender. You still need to meet the eligibility criteria of the council and have under the capital limit, but they can lend you what you need rather than restricting it to that local authority rate. So it follows on from the 12-week disregard. The money during the 12-week disregard does not have to be paid back. This money does have to be paid back after the person has died or sooner if you wish to pay it sooner. They'll put a charge against the property that makes sure that they get their money, so they would prefer that there is no charge already on the property. And of course it needs to have equity in it, needs to be of a decent value and not got any structural problems, etc. So it's an option. You might not get told about it. You should certainly seek advice from ourselves if you're considering it, but it is there, and the people that just rush to sell a property think that they have no choice. This at least is choice. So looking at self-funders, in case this is happening a bit further down the line, perhaps for some of you, it could be happening already for some of you. If we've worked out that the individual needing care is a self-funder in a more broader context, families normally have two concerns. If they're choosing a care home, how do they know what they can afford? Because without a crystal ball and without knowing how long their loved one might need care, it's quite difficult to do cash flow forecasting. And of course, they are inevitably worried about what happens if the money runs out. Will the local authority pick up the tab? Will the care home be okay with that? Brings a lot of concern and worry, and it's actually quite difficult to get straight answers to those questions. So what we do, our sort of core day-to-day, when I'm not recording webinars, our day-to-day job is to talk to families in this situation, to listen to their concerns, and where appropriate to put forward a solution that about 85% of them will have never heard of. Absolutely crazy really when you think about it, but I was in this 85% when my family went through it. And as I say, many years later, the families we talk to, 85% of them have not heard about it. I don't want this to come across as a panacea. It's absolutely not for everybody. if we talk to a family and they looking at a particular care home and we work out their loved one has maybe enough funds for a year, 18 months, 2 years, there's nothing we can do, no solutions that we can put forward that would stop that money running out in the event their loved one is there for that period of time. All we can do is explain how the state funding process would get kicked off and when. However, if somebody has sufficient funds for probably upwards of 3 years, then we'll introduce this solution, tell them about it, and we'll assess if it's viable. So I'm mentioning it today just for the purposes of education, information, awareness. It might be relevant for somebody you know, even if not for yourself. And what this financial solution, is a way of capping costs yourself. But I have to stress this can only be done at the point that care is needed. So you actually have to have a care bill coming in from a care agency, a formal carer, or from a care home, or about to have a bill to pay to be eligible. You cannot any longer insure yourself ahead of time for care costs. You did used to be able to buy pre-funded, but you can't do that anymore. So you can insure care home fees. We're familiar with insurance, but normally we think about it as being done ahead of time. So insuring the car before the crash or the house before the ceiling collapses. But with care fees, you do it the other way around. You do it when a need arises for paying for care. The technical term, the sort of Google search engine term, if you will, is care fees annuity. But people the word annuity normally conjures up poor value. People mix it up with retirement annuities. You may even talk to professionals, accountants, solicitors, IFAs, who say, oh no, annuities are poor value, or they'll be really expensive, so on and so forth. Generally, they are referring to retirement annuities that were designed to pay out for 20, 30 years, to pay a widow, to cover inflation and so on. The big pot of money, when converted to an income, didn't go very far. A care fees annuity is typically for somebody much, much older. Our average client age is 89. So it's for somebody much, much older who has a need to pay a particular amount of money every year for life, not knowing how long that will be, and who will have some health conditions. So there's no way the insurance company offering the product is planning to be paying out for 20 or 30 years. So that's where it differs. Similar in that you pay a lump sum up front and you get a guaranteed tax-free income for life. That's the similarity. But where they differ is the care fees annuity is always individually underwritten to take into account the person's age and their state of health. So it looks very different. And a professional who tries to tell you it'll be too expensive, until you get the individually underwritten quotes, nobody knows, ourselves included. We're probably in a better position to guesstimate what one will cost because we've got years and years of data of getting quotes for these people. But most financial advisors, if they've even heard of the product, will have a very limited experience of what the quotes look like. So, you have to be careful of getting that advice out there on the grapevine, as it were. You need to come to a specialist like us if you genuinely want to consider this product. So individually underwritten. So they'll write to a GP, they'll write to the care provider, they'll take information from the family. They don't involve the individual. The individual's not assessed, won't even know this is going on necessarily. And each quote, therefore, is different. So it's fully portable. So some families might look at this to fund a carer at home, a live-in carer, or just a certain amount of care. But if the situation changes and a move into care, a residential care home happens, the income is fully portable. It can be linked to cover inflation, but it doesn't have to be if there's other money left over. We'll advise on all these options, and we will also advise on extra protection options such as capital protection or delaying the start date of the policy, which serves to also act as capital protection. It's a gamble. There is no getting away from it. This is not an investment. This is not something that you buy and then you change your mind and take the money back out. Once it's purchased, you've got 30 days to cool off and then that's done. But the income is there for life, whether that's 1 year or 10 years. So it gives you that complete guarantee and peace of mind. But the risk is, of course, if the person were to die soon after the plan was purchased, then the estate has lost money, no doubt about it. But some of the estate is protected if it's the other way round and the individual has longevity. Families, of course, are still concerned about that gamble. So, as I say, we'll look at the ways we can sort of balance that and mitigate it. Our job is very much, if someone's interested in this product, to assess the need, work out the income requirement, to then go out to the insurance companies that offer these plans and get the best quotes, and to give you all the advice that you need around it. So all the questions that you'd be thinking now, what would I want to know about this? That will all be provided in a report by ourselves. The plans are fully protected by the Financial Services Compensation Scheme, no 85,000 cut off, so they are truly safe. Not often you can say that about a financial product. And people buy them to either ring fence the remaining assets, to know that if I buy this plan, this money over here, it can be distributed according to the wishes of the will. It also takes away that worry of, will the local authority fund or not? Will it be enough or not? The local authority is never going to be involved if we have one of these plans properly set up in place, paying for the care. If somebody doesn't need it anymore, and the only time that normally happens is if they do qualify for NHS funding at a later point in their care journey, the money from this income goes to them. They still receive it, goes to them instead of the care home. It will then suffer a small tax charge because it's going to them, not the care provider. So it goes to the care provider, it's tax-free. The tax rate is negligible. We don't charge for researching this option. We've got enough experience that we can tell you within a 10-15-minute conversation what it's likely to cost, so you can assess if it's viable. We don't want to put up that cost barrier, so we're happy to get the quotes for you free of charge. But as I mentioned earlier, there has to be some element of earning in our business model for everything else to be free, and this is where we get paid. There's no bias. At the end of the day, you're making the decision whether this works for you or it doesn't. Around half the people we do reports for think it is for them and make a purchase, and roughly half don't. Our business model works on that. It completely accepts it's not for everybody. So we will be paid a fee if a purchase is made. These are the insurance companies that we approach. These are the only insurance companies that offer these types of care annuities. And remember, these are bought at the time care is needed. They cannot be purchased in advance. The companies won't deal with you. You have to come through an intermediary like ourselves, but we are a very safe pair of hands. You'll see, if you check out Eldercare Solutions on Trustpilot, you'll see reviews from our clients, Legal & General and National Friendly. They only launched their care annuities within the last 3 years, and both companies used Eldercare to pilot their product with. That's how specialist we are, and that's how regarded we are in this space. Okay, so that's just really so that you're aware. This is a useful page on our website. As I say, the home page has got that link for the attendance allowance and for the carers charity, support charity. This particular page tells you a bit more about the care annuity, and it's even got a calculator on there where you can sort of get an estimate. It only works for the over 80s. That's not to say you can't have this product if you're under 80, but the data is not quite so reliable. We'd perhaps prefer to talk you through the parameters of likely cost in that scenario. So advice@eldercaregroup.co.uk is the best route really for contact or questions to be answered, because that's manned outside of office hours. We do have an 0800 number that is office hours, and of course you have the website address there. Just in closing, I want to give you my top 3 tips, if you like, for people that are just sort of entering into this space and thinking ahead, probably on behalf of other people, but actually for yourself and for those other people. You must get lasting powers of attorneys set up. If you have an old enduring power of attorney, that is still valid. They stopped being created in 2007, but they're still valid, but they only cover matters of money. You need, really ideally alongside that, the health and welfare one, and if you don't have the EPA, set up this finance LPA. We can put you in touch with people that can assist you to do this. You can do it online, but mistakes can be made. You don't necessarily have to use a high street solicitor and pay those prices. There is a sort of middle ground. We can put you in touch with people, but these documents are so important, and it's so important that they're done and set up when they are not needed. If you leave it too late to when they are needed, if there's a capacity issue, they can't be set up. And then we're talking about having to approach the Court of Protection for a deputyship order, which is to be avoided at all costs, in my experience. So any further advice you need, but this isn't age related, everybody should have these. We've seen, I'm not usually one for quoting the media and so on, but we've seen the situation with Kate Garraway playing out, where her husband has had incapacity for some time and she doesn't have access to the family finances. People assume next of kin gives you all sorts of rights. It doesn't in this space. Equalising the estate, if historically sometimes couples hold disproportionate amount of savings for tax reasons, there comes a point post-retirement that it might be sensible to equalise, because the local authority sort of don't look behind the scenes, they just look at who owns what at face value. And if one of you owns most of it, and that one of you goes into care first or needs the means test assessment first, then it will be unfair. So equalising the estate is sensible, and as I mentioned earlier, certainly at the point of a care need, taking the money out of a joint savings account, only your 50%, but equalising makes sense as well. And again, this isn't something that we do, but we can put you in touch with people that do it. We often get asked about well, just give the property away, and as long as you do that 7 years in advance, all is good. The 7-year rule is exclusively to do with inheritance tax mitigation. It has nothing to do with care fees. Any transfers, gifts, anything anybody does that the local authority believe was done to avoid spending it on care costs, it will be treated as deliberate deprivation of assets. Okay. And I would just say on that point, from what I see when social services are involved, there's an extreme lack of choice and control. And if you've given away your assets to then be at the mercy, if you like, of what the local authority decide is appropriate for you, it's a completely different experience to had you retained some of those assets and been able to use them for your own care. It's balancing it with what the kids think that they'll get as an inheritance and what mum and dad would have wanted, etc. But honestly, to give everything away in inverted commas successfully and have your care decided by the local authority, that's not what I would want, ideally, for my parents. But anyway, the legitimate thing you can do ahead of time is to own your property differently. So to own it half each rather than jointly. I own my half, my husband owns his half, for example. Own it as tenants in common. It makes no difference while we're both here. It makes no difference if we both go into care, etc. But in the event that one predeceases the other, as long as the will has been changed to reflect this, then my half doesn't have to be left to my husband, it can be left to my children. And then if my husband needs to go into care, only half the house is assessed. So this is different to giving everything away, completely different. This is not deliberate deprivation. It won't help if both parents need care, but in the scenario that one does, one doesn't, it could be a legitimate way to protect half the property value. So they're my top 3 tips rushed through. I think they're my top 3. And these are my useful links for you. This Facebook group is amazing. It's almost worth joining Facebook just to join the group. Odd title, not tripping off the tongue, but Safeguarding Futures Health and Social Care Support, set up by somebody who was in financial services and the legal profession, somebody who was an NHS assessor couple, and they're doing this for all the right reasons because they've been through this with their parents and they've got a lot of knowledge to share. So it's a really good place to discuss your concerns openly with a really supportive group. A couple of independent social workers I'm going to put links up to here, because sometimes just waiting for social services to do an assessment at the moment is taking a long time. To get an independent view and to get an advocate and a supporter on your side who can help you navigate the system might be invaluable. The first one, I believe, is based in Cheshire. The next one is based in Northamptonshire, but I think both companies can work sort of as we do, fairly remotely. So they may be helpful to you. As I say, I can give you an indication and my knowledge of the system, but these are people that have actually worked in that side of things. I can do the financial services side. They very much can do the social worker side. And we haven't really touched deliberately on equity release. That's not what this webinar was about, but it can be a good solution for people living in their own homes, wanting more care than the direct payments from the council will provide, and who might want to release extra funds. This is a really, really good company. I've worked with them for years and years. I would take my advice from them if I needed equity release advice. Later Living Now. So a good website, useful information there. I think that will be really helpful to you. And the last one I'm going to put up there is a website, yes, but it does have a call centre. They're real people. I've met them, seen them, based in Oxfordshire, but again, doesn't matter location. It's done remotely. They can help you to narrow down care homes by location, by specific requirements, and they can help you find home care agencies as well. Lots of other info on there, so that's a really, really good source. There's a few that do it, but some of them are just kind of very much algorithm based. These are real people. So that's my short list of useful links. As I say, have a route around our website as well. If it's not relevant to you now, as I say, we're very much at the point of need rather than the planning ahead. But I think between us and these other organisations, we should be able to put you on the right tracks with any questions that you have. So thanks very much for tuning in. I fear I have gone over the suggested time, but you have the pause button and the replay button, so hopefully it's not a problem. And good luck to you all on your individual journeys.